tides are turning. Another red day in the S&P 500, another tech-led sell-off, and another volatile day, leaving both the bulls and bears bewildered. Stocks, commodities, bonds, and cryptos were all in the red in what was a flight to cash and a market liquidation as the great rotation trade takes a break. So when nothing makes sense at all and all assets get sold, what happens next and how should we be positioned? Today, I am bringing you the data and stats, aligning the macro and micro, giving you the why and where as to what happens next in the market, and answering the question, is there more downside incoming? And if so, how do we hedge accordingly? That's what we're going to talk about, along with sentiment, seasonality, and of course, earnings. We had some big hitters report earnings here today, and it's time we dive into the details just to see where we stand in some of the big names. Are expectations too high, or are we about to have a stellar earnings season? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and pretty much red everywhere except in two sectors, energy and semiconductors. Now, semiconductors was green on the back of TSM. They dropped their earnings and that lifted semiconductor stocks. Nvidia up 2.5%, Broadcom up 2.9%, but we did see ugly action in stuff like AMD, MU. Intel continues to be a standout performer in the semi space in the last week. Energy was green and it was red pretty much everywhere else. There were pockets of green in stuff like insurance and financials, Meta, home builders as well. D.R. Horton reported great earnings. They were up 10%. That lifted that part of the market. But other than that, it was red across the board. I mean, even energy was only up 0.2%. Technology was actually flat on the day, mostly lifted by semiconductors. That was after yesterday's 3.4% down day in tech. Kind of crazy price action we're seeing in the market right now. A definite rotation, but today there was no rotation. Today was a liquidation everywhere. The worst performing sector was healthcare, financial, discretionaries, cyclicals, defensives, growth. They all got sold today. And it wasn't just in large caps. It was across all sizes, small, mid, large, value, core, and growth. They all got sold off, with smalls actually taking it on the chin. And that just comes with the high beta nature of small caps. But again, today was a liquidation. I think a lot of it had to do with political tension, geopolitical tension, as well as trade risks. You know, we normally do get volatility leading up into the election. This is probably one of the most divisive elections we've ever had. One of the running mates literally had an assassination attempt last week. A lot of tensions in the air with who's going to win, what policies will come as a result. And that's why we saw the liquidation we did today. And I think the market just realizing we've run up a lot. We're starting to rotate. That could mean large caps could come under some serious pressure. And the election is getting closer and closer. Things are getting more divisive. Let me just go to cash. Let me just sell some of my winners. And then we'll check back in a couple of weeks. And on a day where you have stock market factors all red, you have government bonds selling off, corporate bonds selling off, you have commodities all selling off except natural gas, people getting out the market, wanting to hold cash. The markets have run up in a very big way, and participants are just saying, give me the safety of cash while everything cools off a little bit, both in the market needing to cool off, wanting a breather maybe in some of the larger cap names, and just with the political tension we're seeing. And I think that's a lot of the price action we saw here today. Now it's going to spill over into Asia, into Europe, here in Australia as well. And we can actually see further downside. So very interesting looking at the gamma charts. Now we did get a move in the call gamma resistance up to 750, but it doesn't really matter because the markets right now are actually below the gamma flip zone, which means we're not in positive gamma or a negative gamma. Liquidity is now a net negative to the market. Dealers aren't buying dips, selling rips. If the market's going up, dealers are buying into the strength, but if the market is selling, dealers are selling into the weakness. And that's why we get these erratic moves in negative gamma. And in a negative gamma environment, what are our targets? Well, we look at the put support 5,300. So that should be the level right now. Now we are sitting right on the gamma flip. That's where the S&P 500 closed the day's trade, pretty much on the gamma flip, slightly below the gamma flip zone. So I think what we have to do is wait and see where the S&P 500 closes the week. Is it above or below the gamma flip? Where the gamma flip zone repositions next week, and then we'll go from there. If the gamma flip zone moves down and the S&P 500 is still below it, that could cause some serious problems in the market, and then we could actually see proper sell side momentum to the 5,300 area in what is a seasonally weak period of the year with oncoming election risk. Also, something to consider, we are officially in the window of weakness. A couple of you guys asked what is the window of weakness, and this is pretty much the option flows in the month. So here here in the first week, we have Vanna and Charm, very, very strong. In other words, dealers buying dips, selling rips. And this actually continues in the second week of the month into OPEX week, and it really starts to trail off after Vixpiration, which was yesterday. Once Vixpiration happens, we then enter the window of weakness where dealers aren't as active, Vanna and Charm on a holiday, dealers aren't buying dips, selling rips, and that's when we can actually get a lot of the downside weakness in markets. So we are entering the window of weakness. We can actually see a little bit of downside, but this all depends, because if we stay above the gamma flip zone next week, we continue to buy dip, sell rips, and we look to the 5750 area. Below the gamma flip zone, we look to the 5300 area as our target in this window of weakness. So here is the S&P 500, and it was a very uncorrelated day today. Stocks fell, commodities fell, bonds fell, yields rose. So a whole bunch of action. I mean, even the dollar just firmed up a bit. But let's talk about the S&P 500. And I think it's probably time that we start getting a little bit bearish in the near term. Still bullish long term. You have to look at this. This is the daily chart year to date. I do think the S&P 500 is going higher, but I think we're going to see a bit of a pullback as long as we stay below the gamma flip zone. If I pull this right here, I showed you it earlier. The gamma flip right now is at 55.95. Now, there's a couple of things we need to realize with this, okay? The very first thing is that tomorrow, this gamma flip zone is going to move down for sure. And depending on what the S&P 500 does, we have to see where that repositions. So let's say the gamma flip moves down, the S&P 500 catches a bid, it's above the gamma flip, then we do what we normally do, and that's buy dips, sell rips to the core resistance, which is now here at 750. But when the gamma flip zone moves down tomorrow or sometime this weekend, it moves down, the S&P 500 is below the gamma flip zone. Our very first target of interest we're going to look at is this 5500 target right here. That's the target we're going to look to as the first target. And it's very, very interesting because that is right here. So this is going to be the first zone that we actually look to here in the S&P 500. If we then break below the 5500 area, the next area of interest is 5300. So below this 5500 area, we're going to see some vicious sell side to like somewhere around here. There's not a lot of support in the JEX chart below the 5500 area. So this becomes very, very critical for bulls at this juncture right here. So it's either we find support at this level, continue the move up, get above the gamma flip, use it as support, break all-time highs, aim for 5750, or on the flip end, what's going to happen is we break below here and then we look to downside target of 5300 sort of in this area right here. So that is the game plan for the rest of the week for the S&P 500. But that is S&P 500 large caps. And as long as we stay in negative gamma, I do think we are going to see a bit of a correction, a pullback to possibly as low as 5300. And if we are to take a measured move from where we are right now to the 5300 area, that represents about 4.3%. Let's call it just a flat 5% downside from where we are right now. The market can possibly go as low as I get 5230, 5250. You know how markets are sometimes irrational. We like to wick below, get to these levels. So yeah, anywhere from 4 to 5% downside from here in the S&P 500. But I do think that we're going to see a resilient IWM, resilient small caps. I think if we are looking at downside targets for the IWM, the obvious target is this 210 level. But I think that you should be a buyer anywhere from 217 to the 210 level, because we could literally just rally up at any point. This is the high beta nature of small caps. We could go to as far as 210, but don't be surprised if we just continue the rally tomorrow in the IWM. Still looking a little bit upbeat here in the after hours, but that's the price you have to pay for outsized returns in small caps. It just comes with quite a lot of volatility attached to it. But I do think that we are going to get to all-time highs in small caps. I think we should be by 240 by the end of the year, 260 by mid next year, and possibly 300 at the end of 2025. I think small caps are going to outperform large size in the next 12 to 18 months by a significant margin, and you need to be allocated to this sector, particularly with the earnings growth we are seeing. So that is my targets for the S&P 500. You have the analysis right there, and then the IWM. You want to be buyers from here all the way down to 210. Have a game plan, have a dollar cost average game plan, because we're going back to all-time highs here, guys. Now let's talk earnings. We had TSMC and Netflix report earnings today. We're going to cover them, but I did have a look at a couple of other names. D.R. Horton, very good earnings. They were up 10% here on the day when the broader market fell. Really good sign for home builders. This is the biggest home builder in the world. Intuitive Surgical was up 6% in after hours, and Domino's Pizza was down 13% on the day. Brutal action in this name right here, but so very mixed earnings across the board. But let's dive into TSM. TSM had great earnings. I think 36% year-over-year growth. They beat EPS $1.48 against the expectation of $1.40. on revenues of 20.82 billion. It was a double beat on both the EPS and revenue side. They actually raised guidance as well from 22.66 billion to 22.4 to 23.2. The market really did like that. Now the stock was actually only up 0.39% on the day because there was vicious sell side across the market. Pre-market, the stock was as high as 3.5%. So the street did like this earnings. And in a time when the S&P 500 and Nasdaq were all red on the day, this is peak outperformance right here, and actually helped to lift a lot of the semiconductor stocks on the day too. Netflix reported after the bell. They actually beat on EPS, beat on revenue, beat on new subscribers, a triple beat. EPS 488 versus 474. On revenue of 956 billion against 953. So a mild to a slight revenue beat, but new subscribers nearly doubling the street's expectations of new subscribers, 8 million versus 4.5. But Netflix was down 1.96% yearly after hours, at one point nearly down 4%, and that's because it had to do with this guidance figure right here. While they did guide above EPS expectations, what the market is really worried about is revenue expectations. And then you start diving into this and asking the question, if you got so many more subscribers, how many subscribers did you lose? Right? Are competitors eating into your market share? Are your subscribers higher quality? Are they more ad tier subscribers versus premium subscribers? And I think that's what the market is grappling with right now. And that's why we saw price action we're seeing in Netflix, coupled with the fact that the valuation is just a little crazy for this type of business. And that's why we're seeing a little bit downward momentum. However, I thought the Q2 earnings was great. Either way, this is still growth on a year-over-year basis for the third quarter. So, the company's still growing. It's not like this is a revenue decline. It's still growing on a quarter-over-quarter basis. And it does look like the company and management are actually looking to find a lot of operating leverage, cut some of expenses, because EPS should come in better than the market's expectation here in the Q3. So not great earnings here today. Great TSM earnings. Very mixed everywhere else across the board. Guys, looking at sentiment, this is the AA sentiment survey. And we just got ever more so bullish. We saw an uptick from 49 to 52.7% in bullish sentiment votes, and we actually saw bears increase as well to 23.4, but still relatively low, all things considered. Essentially what we saw was the neutral side take a bit of a bearish stance and also take a bit of a bullish stance, and it's going to be really interesting to see the outcome. Now, in the history of the AA sentiment survey, anytime we get above the 50% region, we normally do see a pullback. We are starting to see that maybe in the market. We did get vicious price action yesterday in the S&P 500. So if we do see further downside volatility into the weekend, maybe early next week, that is completely normal. But long term, you need bulls in a bull market, and sentiment is very bullish. Now, the reason why sentiment is bullish has to do with case studies like these. This is S&P 500 performance after a turn of the year hat trick. We can actually see when December, January, February is positive, we get very good returns, 7.53% from July 15th to December 15th. So a 6-month period, 7% returns, 23 wins, 2 losses. But the truth is, in the time period we are now, sort of late July, early August, we can actually see negative returns in this period, negative 0.96%, 8 wins, 17 losses. But you should really just buy the dip, because the truth is 3 months, 6 months later down the line, we do get outsized returns of 7.3%. And you can see we do see a little bit of volatility here in September and October, but we normally par those gains and some into October, November, and December. And the reason why we're so bullish right now has to do with earnings, but we talk a lot about S&P 500 earnings. What about Europe? I have the earnings outlook for the stock 600, essentially Europe's S&P 500, and they say European aggregate estimates second quarter earnings are expected to increase 0.8% from the second quarter 2023. Excluding the energy sector, earnings are expected to decrease 1.8%. Revenue is expected to increase 1.1%. Excluding energy, revenues is expected to increase 1.6%. 26 companies in the stock 600 have reported earnings to date for the second quarter. Of these, 46.2% reported results exceeding analyst expectations. In a typical quarter, 54% beat analyst EPS. 29 companies in the stock 600 have reported revenue. 65.5% have beat analyst expectations. This compares to the average of 58%. During the week of July 22, 85 companies are expected to report second quarter earnings. Now you might be looking at this and saying, hey Chase, these earnings are not great compared to the S&P 500, compared to history. So why are European stocks pretty much at all-time highs? Well, the truth is just 12 months ago, this figure right here was very close to negative 7%. We're now pretty much close to flat earnings. And when you get those type of revisions, you do see upward action in all-time highs. Also, the second quarter year for Europe is the inflection quarter. In Q3 and Q4, we're looking at double-digit growth here for the stock 600, as well as double-digit growth in 2025. The market is pricing in all of those earnings as well. And to see these figures right here is actually very, very good compared to the earnings estimates just a year ago. Now, looking at the S&P 500, this is equity ETF valuations, and they are officially above the average. Median 12-month forward PE ratios across both is equity ETF coverage. I believe this actually includes Europe as well. You can see the median ETF 12-month forward PE is sitting right at about 15. Average is about 13, and it's not crazy expensive. This is the average right here. I would say that ETF valuations are fairly valued given the current earnings expectations and macro environment. So with ETFs fairly valued and at all-time highs, how do we extract alpha from the market, especially considering rate cuts are coming, easier monetary policy is on the way? Now, what exactly do you want to own when the Fed cuts rates? It might not be in September, but we do know that rate cuts are coming. And the truth is, you want to be in small caps and you want to be in bonds because they tend to outperform 6 months, 12 months later relative to large caps. We also see value outperforms growth, but it's marginal. You really just want to be in smalls. You really want to be in bonds when the Fed cuts rates. And the truth is, you should already have exposure into large caps because leading up into rate cuts, large caps tend to outperform smalls. So hold smalls, hold bonds. You need exposure to some large caps. If you have that portfolio, sort of like a diversified portfolio, you should do very, very well in the next 6 to 12 months. But if you want outsized returns relative to the S&P 500 and you're willing to take on more risk, you definitely want to look at quality growth over low quality cyclicals. You can see that quality growth outperforms low quality cyclicals when the Fed starts to lower rates. You would think it would be the opposite, but that is simply not the case. And this is why I've been championing get into small caps, get into longer duration, quality small caps and government bonds, because they tend to outperform when the Fed cuts rates. You could see here that when the Fed went on aggressive cutting cycles, we saw quality outperform 23%, 52%, 21%. Most recently here in 2020, up 23% relative to low quality cyclicals. While history doesn't repeat itself, it does tend to rhyme. Do expect quality, despite the outperformance you've already seen, to outperform low quality cyclicals. And again, I'm going to be a champion of the small size factor. I think if you're buying quality small caps like I've championed, you want to buy the CAF index, stuff like QSML and CAF, as well as XSHQ. These are high quality small caps. They should do very, very well over the next 6 months. And the truth is, we are actually going to see more money getting into small caps because small size is 53% underweight by active fund managers. And this type of positioning tends to precede a chase to the upside. Now let's talk about the macro. So the City Economic Surprise Index has been a bit of a dumpster fire here in 2024 since late March, early April. However, we have seen the start of a potential recovery, as you can see right here. And that's because we have gotten economic data that's coming in better than expected. We got better than expected CPI. GDP has been revised to the upside. Yesterday, we got housing starts and industrial production that increased more than expected. And as a result, Goldman Sachs boosted their GDP tracking to 2.6%. They say, bottom line, housing starts increased 3% in June from an upwardly revised May level, slightly above consensus expectations for a smaller increase. Building permits also increased by more than expected in June. Both industrial production and manufacturing production increased in June above expectations. Auto assemblies increased to 13.4 million, the highest level since 2015. June auto assemblies were even stronger than our previous assumption. We boosted our second quarter GDP tracking estimate by 0.3 percentage points to plus 2.6 quarter over quarter. Our second quarter domestic final sales quarter is up 0.1 to 2.2%. So Goldman's GDP figure just a couple of weeks ago was 1.8%. After the CPI figure, they increased it to 2.2%. And then today, they increased it to 2.6%. That is quite the up revisions we've seen in GDP. We've also seen very similar up revisions in the Fed's GDP now for the second quarter. Things were not looking that great right here at 1.5% GDP, but now things are looking like 2.7, 2.6% in line with Goldman's estimates after the stronger than expected data we've received in the last week and a half, 2 weeks. And the reason why this is such a good thing is because GDP is highly correlated to earnings. This is R squared between S&P 500 quarterly earnings growth and macro variables. And you can see your real GDP, nominal GDP is a 42% and 26% correlation. In other words, if GDP is going up, the likely outcome is that earnings is also going to either come in better than expected or grow on a year-over-year adjusted basis. Now, guys, one thing I do want you guys to note is that 90% of the time we avoid recessions and stagflation. This is quarterly US GDP growth year-over-year versus CPI year-over-year 1948 to present. This is when we normally get stagflation. This right here is a recession. 90% of the time we actually just avoid these. In other words, yes, we can get weaker data, but we normally brush it off a couple of weeks or a couple of months later. It's very, very rare that we actually get persistently bad data like we did in 2022. That's when we get a recession. But most of the time, you want to remain bullish because a lot of the time, bad data is normally just a thing that happens every quarter or so. We brush it off and we continue moving higher in GDP, and that's very good for stocks as a whole. Now let's dive into some charts. This is S&P 500 index seasonality, but it starts here in July, and it's a very interesting chart to not look at it from starting in January, but starting from where we are right now. And pretty much from July all the way to October, we can actually expect pretty much sideways action. We can see upside, we can see downside, but pretty much sideways momentum. But October is definitely the place where we want to get long. History tells us that this is a good place to get long into November, December, January, February, where we can actually see a little bit of downside, and then into the rest of the year all the way to June. And pretty much we'll be making higher highs, higher lows from October. But we are in a period where we can see heightened volatility in the S&P 500. Now, diving into seasonality here for rates, this is the average US Treasury yield move after the first Fed cut, 9 prior cycles. So not a huge pool of data, but given the amount of cycles we've had in Fed funds, this is about as good as it's going to get. We're going to look at the 2-year because it correlates most highly to the Fed funds. And you can see 500 days later, we could actually see about 2%, a little bit more than 2% in Fed fund rate cuts. In the 10-year, it's closer to 1%. Long story short, if Fed funds come down, if interest rates come down, if rates come down, bonds go up because they have an inverse relationship. And if the Fed does start cutting, let's say a 25 basis point cut, we then have 6 to 8 more of these cuts left in the tank. That's very bullish for bonds, very good for longer duration treasuries. And history tells us that in a Fed cutting cycle, you want to hold bonds because they should provide great risk adjusted returns. And even if the Fed funds was to decrease by 2%, right, you'll still be getting like a 3% dividend on top of the capital appreciation you get at this point. So great time to get long bonds if you're not already. History tells us that once the Fed starts cutting, rates tend to move lower. Now, looking at the Russell 2000, this is the 1-year performance of the Russell off major lows. Now, they've tagged the major low here at the start of 2023. I would probably go a little bit further, maybe October 2022, but this is the data we have right now. And relatively speaking, we are in a fairly weak bull market. If you consider this a bull market, this is fairly weak compared to the average return right here. And you can see we have highs in 2020 that was very, very high. This is where we are right now. And history suggests that to get to the average, there's probably more upside. I did do the math to get right here. We would need a 21% return and we would be 5.5% above the all-time highs. Very, very doable. Do I think we're going to get there? Yes. Question is not if, but when. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.